Welcome to the deep dive. Today, we're tackling a big one, really trying to crack open the operations, the strategy, and the financials of a true giant in professional services. Accenture plc, ticker ACN.
Yeah, this is a behemoth. If you want to understand the engine behind so much of global commerce today, I mean, the digital transformation, cloud migrations, now AI integration, you're looking right at Accenture.
Absolutely.
So our mission today is pretty clear. We've got a lot of detailed investment research here, and we need to boil it down. The goal is to get beyond just the headlines, to really understand this complex, massive business, and especially how it's navigating this major shift, moving from that post-pandemic investment boom into this new era defined by Gen AI.
It's a huge undertaking. I mean, the scale is it's hard to wrap your head around. This is a global services powerhouse, right? S&P 100. They operate in over 120 countries and employ, what is it, around 774,000 people globally?
That's right, 774,000. That workforce is bigger than the population of quite a few cities.
It really is.
And their mission is just as big. They're there to help the world's top organizations build out their digital core, streamline operations, navigate all this constant change. And they're not just creating PowerPoints, they're actually integrating systems, managing entire business processes, and sustaining these huge transformation efforts, often over many years.
So it's that breadth and depth from the strategy session right down to running the operations. That's really their edge.
Exactly. That's precisely what defines their competitive advantage, I think.
Okay, let's try and unpack this operational complexity. How does a company with nearly 800,000 people actually structure itself to sell and deliver all these different services? The research breaks it down into 5 main service lines.
Yeah, it's quite a smart structure, actually, kind of modular. They've built these distinct areas, but they work together, allowing them to cross-sell and offer these really comprehensive end-to-end solutions.
So the first one, maybe the one people think of most, is strategy and consulting. That's the classic advisory work, right? High-level stuff.
That's it. Sitting down with the C-suite, figuring out enterprise strategy, navigating those big organizational changes, maybe finding ways to cut costs significantly. It really sets the direction for everything else Accenture might do for that client.
Right, sets the stage.
Exactly. And once that strategy is in place, then the second line, technology, often kicks in. This is really the implementation powerhouse, probably their largest single unit.
And that covers?
Oh, all the core IT services. System integration, building applications, and crucially, cloud migration. You've probably heard of their Cloud First initiative.
Yeah, that's well known.
And this technology group is also where their growing data capabilities and specialized AI work sits. It's the nuts and bolts of making digital transformation actually happen.
Okay. Then number 3 is operations. Now, this is different, isn't it? This is less about projects and more about ongoing services.
Exactly. This is where the revenue model shifts towards that long-term annuity-style income. We're talking about managed services, or sometimes called business process services, BPS.
And why is operations so important strategically?
Resilience. It's all about resilience. Accenture essentially takes over and runs certain functions for the client. Think finance and accounting, HR processes, procurement, maybe parts of the supply chain.
So they're not just advising, they're doing.
They're doing. And they use automation, AI, their global scale to optimize those processes, often promising specific performance improvements. It's about becoming deeply embedded in the client's day-to-day business.
Got it. Okay, the fourth one is interesting, Industry X. This isn't general enterprise tech, is it? It sounds more specific.
Yes, and it's becoming increasingly important, especially with, the Internet of Things and smart manufacturing really taking off. Industry X is focused squarely on digitizing the industrial world.
Like factories and products.
Exactly. They work on R&D processes, creating smart, connected products, optimizing manufacturing lines, improving supply chain visibility, basically connecting physical assets and operations back to that digital core we talked about.
So making factories smarter, connecting products to the network.
Precisely. It's crucial for clients who need efficiency gains beyond the standard IT department focus.
And finally, number 5, Song, which used to be Accenture Interactive. I remember when they launched that, it felt a bit different, maybe like an ad agency bolted on.
Yeah, it might have seemed that way initially, but it's far from an anomaly now. It's a massive part of the business and a key growth engine. Song is their creative, marketing, and customer experience arm.
So helping clients grow their top line, not just cut costs or improve IT.
Right. It aims to blend that high-end creativity, the kind of work you'd expect from a top advertising agency, with deep data analysis and technology implementation. And the scale is often underestimated. Song actually passed $10 billion in annual revenue way back in fiscal 2019.
10 billion, wow.
Yeah, it means Accenture isn't just positioning itself as a tech partner. They can own the entire customer journey, from the initial business strategy right down to the creative campaign and the e-commerce platform it runs on.
That holistic approach. Yeah, that explains a lot about why they're so dominant. Okay, let's zoom in on something you touched on earlier, this crucial revenue mix shift. You said this isn't just happening, it's a deliberate strategic choice.
Absolutely. It's fundamental to understanding their strategy right now. We can broadly categorize their work into two types. There's consulting, which is usually project-based, tends to have higher margins, but it's shorter term. And then there's managed services, primarily from that operations group, which involves long-term recurring contracts, thick outsourcing deals. These offer much better revenue predictability.
Okay, so consulting is project work, managed services is ongoing contracts, and the data shows a clear shift. Fiscal 2023, consulting was just over half, right? 52.4%. Managed services at 47.6%.
That's right. But look at the more recent data. By the third quarter of fiscal 2025, that gap had almost disappeared. Consulting was down to 50.8%, and managed services had climbed to 49.2%.
So nearly 50-50. That might seem like a small percentage shift, like 1.6 points, but given their scale, that represents billions in actual contract value moving across.
Billions. And it signals a really fundamental change in the company's financial risk profile. Management is actively pushing towards this balance.
So why? What's the big strategic advantage for the listener here? Why deliberately aim for that almost even split?
It boils down to stability and resilience. Consulting revenue, the project work, is highly discretionary. When the economy looks shaky, what's one of the first things CEOs cut back on?
Big new IT projects.
No.
Consultants.
Exactly. So that revenue stream can be quite volatile. Managed services contracts, on the other hand, are typically multi-year deals, often 5, 7 years, or even longer. They're deeply embedded in the client's core operations. They're much harder to cut quickly.
Because the client relies on them day to day.
Precisely. These contracts keep generating revenue, predictable revenue, even when the economy slows down. So by shifting the mix towards managed services, Accenture is effectively building a larger, more reliable revenue base.
Which gives them better visibility on future earnings, less fluctuation.
Absolutely. It lets them navigate economic headwinds with more confidence. It allows them to keep investing, like in M&A or R&D, even during downturns, which is a massive advantage over competitors who might be purely reliant on that volatile project work and have to slam the brakes on spending.
Makes sense. Okay, let's talk about how they manage this globally. They're enormous, but they need to operate locally everywhere. How does that work?
Well, their geographic diversification is definitely key to managing that global risk. They've actually done some reorganizing recently in fiscal 24 and 25 to group markets into these larger super regions.
Okay.
So the Americas are the biggest chunk, accounting for about 51% of total revenue as of Q3 fiscal 25. Then you've got EMEA, that's Europe, Middle East, and Africa, which is a pretty substantial 35%. And Asia Pacific makes up the remaining 14%.
And within those regions, what about the client relationships themselves? You mentioned they're not just winning one-off projects, but building these really long-term partnerships.
That's absolutely core to their model. It's not just about scale, it's about depth. Get this. The average relationship length with their top 100 clients is more than 10 years.
A decade.
Yeah. They become deeply integrated. Management even tracks this specific metric they call diamond clients. These are their biggest, most strategic multi-service partnerships.
Yeah.
That number actually grew from 300 in fiscal 2023 to 310 in fiscal 2024.
So even during a broader slowdown, they added more of these top-tier clients.
Exactly. That says a lot about client trust and just how sticky those relationships are once they're established.
And that resilience is also helped by diversification across different industries, right? They're not overly reliant on any one sector.
No, they have a really healthy spread. Looking at fiscal 2024 numbers, products was the largest at about 30%, then health and public service at 21%, financial services around 18%, communications, media and tech at 16%, and resources at 15%.
So a good mix.
It acts as a natural hedge. You know, if financial services hits a rough patch because of regulations and cuts back on spending, may the public sector, which often runs on longer-term government budgets, stay stable or even grows due to mandated system updates. This portfolio approach really buffers them against the specific ups and downs of any single industry.
Okay, that gives us a solid picture of the business itself. Let's shift gears now and talk about the environment it operates in, because the industry dynamics, especially with AI coming in so strong, seem to be reshaping absolutely everything. Right. Moving into part two, let's talk about the market itself. Accenture plays in these massive arenas, management consulting, IT services. The scale is just huge, but you mentioned it's the pace of change and growth that's really striking.
Yeah, the overall market is enormous. Professional services is easily a multi-trillion-dollar space globally. If you break it down, management consulting is estimated somewhere up to $410 billion for 2024. But IT services, that's the real giant, approaching $1.5 trillion this year.
1.5 trillion.
Exactly. And critically, these aren't sleepy, mature markets just ticking along. Both are forecast to keep growing quite aggressively. We're looking at projected compound annual growth rates, CGRs, somewhere in the range of, say, 7.3% to maybe even 11.6%.
Why is there still so much growth? You'd think after years of digital transformation, things might be slowing down.
Well, it turns out digital transformation isn't really a destination. It's more of a continuous journey. The core driver is this persistent, even accelerating need for companies to keep modernizing. Cloud migration isn't finished for everyone. Cybersecurity threats are constantly evolving, getting worse, actually, and the regulatory landscape just keeps getting more complex.
So always something new to adapt to.
Always. But the biggest new catalyst, the thing really injecting energy right now, is undoubtedly generative AI.
Okay, Gen AI. This brings us to what you called the double-edged sword. On one side, it looks like a massive immediate opportunity for Accenture.
Oh, absolutely. It's like a new gold rush for consultants. Accenture's own research found something like 97% of executives see technology, and especially AI now, as absolutely critical for reinventing their business.
But they need help figuring it out.
Exactly. They need help deciding which AI models make sense for them, how to actually integrate these things with their often messy existing systems, and crucially, who is going to govern the use of this powerful new tech. That translates directly into immediate demand for high-value, high-margin consulting work for firms like Accenture.
Okay, but then there's the other edge of the sword. Implementing cutting-edge tech often creates new problems, doesn't it? You mentioned technical debt.
Right. AI is incredibly powerful, but it's also complex. And technical debt here basically means the future cost you incur by not properly cleaning up your existing IT systems before you bolt on sophisticated new AI tools.
So you're layering complexity on top of complexity.
Pretty much.
Mm-hmm.
And Accenture actually found that 41% of executives point to AI as one of the top 3 things already contributing to their company's technical debt. Now, ironically, this complexity also creates another service opportunity for Accenture. They get paid not just to deploy the AI, but also to help manage the integration headaches and clean up the mess the new tech can create.
So short-term demand looks strong, driven by both the opportunity and the complexity. But what about the potential long-term threat? The sort of scary part for Accenture's model?
Yeah, that's the really crucial strategic question. The risk of long-term cannibalization. Over time, as these generative AI tools get smarter, more integrated, and easier to use, they're going to automate a lot of the routine, predictable tasks.
Tasks currently done by humans.
Yes, tasks currently done by junior consultants or maybe analysts, and critically, many of the high-volume, rules-based activities that make up traditional managed services contracts.
Can you give some examples? What kind of work in a managed services deal might AI automate?
Think about things like basic software code review, generating standard reports automatically, initial stages of legal document discovery, drafting simple contracts based on existing templates, or handling straightforward Tier 1 customer service questions.
Okay, lots of routine stuff.
Lots of it. Yeah. And if AI can do those tasks faster, cheaper, and maybe even more accurately, what are clients eventually going to do?
They demand lower prices on those managed services contracts, or maybe think, hey, if the AI handles 80% of this now, maybe we can just bring it back in-house.
Exactly. That puts enormous constant pressure on Accenture to keep moving up the value chain.
So they can't just rely on doing the same things forever.
Absolutely not. Their long-term survival really hinges on their ability to continuously pivot their workforce away from tasks that are becoming easily automatable. They need to focus their people, all 774,000 of them, on the strategic, complex, creative work that AI can't easily replicate.
Like
things like designing completely new business models, handling complex organizational change management, developing bespoke creative marketing campaigns, or crafting really sophisticated multi-year geopolitical risk strategies for supply chains. They constantly have to stay ahead, teaching their massive workforce to essentially outrun the algorithms they themselves are deploying. It's a fascinating challenge.
It really is. Okay, so in this turbulent environment, how strong is their competitive position? The landscape seems incredibly crowded and diverse. Who are they actually up against day to day?
It's a very fragmented battlefield. You've
Yeah.
got the big traditional global IT services players, think IBM, Tata Consultancy Services, TCS, who are heavily focused on large-scale outsourcing. Then you have the consulting arms of the big four accounting firms, Deloitte, PwC, EY, KPMG, who often leverage their audit relationships to get consulting gigs.
And the strategy firms.
And then you have the elite strategy boutiques like McKinsey, Bain, BCG, who often have those really tight relationships right at the CEO level, focusing purely on high-level strategy, plus countless smaller, specialized niche players and actual providers competing on price or specific skills.
So fierce competition from all sides. Yet the analysis consistently points to Accenture having what's called a wide economic moat. What protects them? What are the key pillars of that defense?
The research suggests their moat rests primarily on two strong pillars. The first is intangible assets. This mainly comes down to their incredibly powerful global brand and reputation.
How does brand become a moat in this business?
Well, think about it from the client's perspective. If you're a CEO about to sign off on a massive, potentially career-defining, multi-million or even billion-dollar transformation project, risk aversion becomes paramount. Choosing Accenture, a brand that's been named the world's most valuable IT services brand for, I think, 7 years running now, is seen as the reliable, safe choice. It reduces the perceived risk for the executives making the decision.
Ah, the old saying, nobody ever got fired for hiring IBM, or in this case, Accenture.
Pretty much. That brand trust, built over decades, is incredibly valuable and hard for competitors to replicate.
Okay, brand is one pillar. What's the second?
The second is high switching costs. This is more of a practical technical barrier. Once Accenture services, especially their managed services, become deeply embedded within a client's core operational processes, it becomes incredibly costly, time-consuming, and just plain risky for that client to switch to a different provider.
Can you unpack those switching costs a bit more? What makes it so hard to leave?
Imagine a large bank that has outsourced its entire back-office IT infrastructure management and maybe its core banking application maintenance to Accenture under a 5- or 7-year contract. Switching means finding a new vendor, transferring vast amounts of system knowledge and potentially proprietary code, retraining internal staff on new procedures, migrating potentially thousands of applications, and facing significant risks of operational disruption, data loss, or security breaches during the transition.
Sounds like a nightmare.
It can be. The internal cost and effort required to switch often dwarfs the actual fees being paid to Accenture in any given year. This operational lock-in creates real long-term stickiness and makes those multi-year contracts much more secure.
And finally, just trying to build a competitor with Accenture's sheer scale and global reach seems almost impossible today.
The barriers to entry are just immense. To replicate their global delivery network, they have something like 100+ innovation hubs around the world, plus recruit and train that kind of specialized workforce. You need billions upon billions in capital investment and probably a decade of flawless execution.
Plus the relationships.
Also, deep, established partnerships they have with all the major technology ecosystems, Microsoft, AWS, Google Cloud, SAP, Salesforce, you name it. A startup can't just conjure up those kinds of preferred partner relationships overnight. They've been building that ecosystem for decades.
Okay, that competitive analysis sets the stage really well. Now let's dive into the actual numbers and see how this giant strategic machine translates into financial performance. All right, let's move into part 3. Financial performance and cash flow. And the story here, looking at the recent numbers, is definitely one of cycles, isn't it? Reflecting what happened in the broader tech and consulting world, a huge boom, then a pretty sharp slowdown.
Yeah, the long-term picture shows incredible growth. Accenture managed to double its revenue over the past decade, hitting $64.9 billion in fiscal year 2024. That's impressive scale. But the year-to-year swings really highlight how sensitive this sector can be to the macro environment.
And the peak of that cycle, around fiscal 2022, was really something else.
It was almost frantic. Revenue growth absolutely rocketed, peaking at 21.9% in FY 2022. That was the absolute height of the post-pandemic digital investment frenzy. Companies were just throwing money at anything that promised remote work enablement, supply chain resilience, cybersecurity.
The catch-up spending phase.
Exactly. But then, as interest rates started to climb rapidly and worries about a recession grew, that spending climate changed dramatically.
The brakes came on hard.
It really did. Growth slowed significantly, down to 4.1% in fiscal 2023 and then it really cooled off, hitting just 1.2% growth in fiscal 2024. That sharp deceleration is almost entirely down to client caution executives delaying big discretionary transformation projects until they felt more certain about the economic outlook.
Okay, so revenue growth definitely hit a wall. But what's striking is how well they seem to manage their profitability through that. The margins look incredibly stable.
This is where that strong competitive position and operational discipline really show up in the numbers. Despite intense competition, rising wages, especially for those in-demand AI and cloud skills, they've managed to keep their profitability remarkably steady. Gross margin held firm at 32.6% in FY 2024. And their adjusted operating margin was very robust, right around 15.5%.
Which is pretty impressive given the top-line slowdown.
It really is. It demonstrates significant pricing power. They aren't being forced into deep discounts and just world-class cost management across that enormous global workforce.
Now, given it's a services business, relatively capital light, you'd expect strong returns on capital. Let's look at return on equity, ROE, and return on invested capital, ROIC.
Right. Their trailing 12-month ROE is excellent, running at 27.1%. That confirms the basic model. They generate high profits without needing massive investments in factories or equipment. However, the return on invested capital, the ROIC, paints a slightly different, more strategic picture right now. We've actually seen a notable decline in ROIC. It peaked around 31.4% back in FY 2022, but it fell to 19.0% in FY 2024.
19%, that looks like quite a drop. If their operating margins are holding up, what's driving that decline? What's the key insight there?
It's not really a sign of deteriorating operations. It's more an arithmetic result of very deliberate, aggressive spending choices by management, specifically a massive expansion in investment. In fiscal 2024 alone, remember, they deployed a huge $6.6 billion on mergers and acquisitions, M&A, and another $1.2 billion on R&D. This dramatically increased the invested capital part, the denominator, in that ROIC calculation.
So the capital base grew significantly.
Exactly. And the financial returns from those specific recent investments haven't fully flowed through to the return part, the numerator yet. It takes time for acquisitions to be integrated and start generating the expected profits.
So rather than a red flag about profitability, this lower ROIC is actually reflecting their counter-cyclical growth strategy. They're investing heavily now.
Precisely. They're using their financial strength to buy assets, talent, and capabilities while the market is maybe a bit softer and valuations are more attractive. We definitely need to watch ROIC to make sure those investments do eventually pay off, but for now it mainly tells us they're in a very intense investment phase, doubling down on future growth rather than just optimizing for current returns.
Got it. Okay, let's talk about cash flow. This seems to be the bedrock of their financial strength. They generate a ton of free cash flow, FCF.
An absolute ton. They produced $8.6 billion in free cash flow in fiscal 2024. And the business model is just incredibly efficient at converting profit into cash. Their capital expenditures, money spent on buildings, equipment, etc., were tiny, just $517 million. That's only about 5.7% of their cash from operations.
So most of the cash generated stays available.
Right. That high cash conversion is a massive competitive advantage. It funds their dividends, share buybacks, and that huge M&A program we just talked about.
And a really interesting indicator of their operational strength is something called negative net working capital. Can you explain what that means for our listeners?
Yeah, this is a really powerful position to be in financially. Negative net working capital basically means the company collects cash from its customers faster than it pays its own suppliers and employees. In FY 2024, Accenture ran with negative net working capital of about negative $1.46 billion.
So in effect, their clients and suppliers are helping to finance their operations.
Essentially, yes. It's a testament to their strong bargaining power in contracts and their efficient billing and collections processes. It means they don't have to tie up their own capital financing inventory or waiting long periods for customer payments.
That sounds fantastic. But even here, looking closely at the working capital numbers, there's maybe a subtle sign of the broader economic stress.
There is, yeah. You need to look at the cash conversion cycle, or CCC. This measures how long it takes, in days, for the company to turn its investments and resources into actual cash flows. That CCC is actually lengthened, going from about 43 days back in FY 2022 up to 51 days in FY 2024.
Okay, so it's taking about a week longer to convert operations into cash. What's driving that increase?
It's primarily driven by an increase in days sales outstanding, or DSO. That's the average number of days it takes them to collect payment after making a sale. DSO rose to 73 days in FY 2024.
73 days. And what does a rising DSO signal in practical terms?
It generally signals increased client caution. It suggests that in a tighter economic environment, clients are stretching out their payment terms a bit, taking longer to pay their bills. It might indicate that Accenture's pricing power, while strong, isn't absolute, and they're having to perhaps offer slightly more flexible terms to close deals.
So it's a subtle indicator that things are a bit tougher out there, even for Accenture.
Exactly. It's not alarming yet, but it's a small warning sign that their collections teams are likely working harder, and a bit more capital is getting tied up in receivables than may be ideal. Something to keep an eye on.
All right, given that backdrop, the growth slowdown, the slight pressure on working capital, let's pivot now to part 4, growth strategy and the future. It seems abundantly clear the core plan now is all about reigniting growth by leading the charge on AI.
Absolutely. The entire strategy seems to revolve around positioning themselves as the client's indispensable reinvention partner. They seem to view this current slowdown not just as a challenge, but as a crucial window of opportunity to fundamentally reposition the company for the next decade with AI at the absolute center.
And a huge part of that is investing heavily in their own people, specifically those with AI skills.
Massive investment in human capital. They're not just talking about Gen AI. They're putting serious resources behind scaling up their workforce. They set this incredibly ambitious public goal to double their dedicated data and AI workforce from 40,000 people to 80,000 specialists by the end of their fiscal year 2026.
Doubling that team, that's a huge undertaking in terms of hiring and retraining.
Huge. It requires significant investment in recruitment, but also in upskilling their existing massive workforce.
And is this focus already translating into actual business? Are clients buying these AI services yet?
Yes, we're seeing clear evidence it's gaining traction. The company reported that Gen AI-specific new bookings, so contracts explicitly focused on implementing AI strategy and solutions, hit an impressive $1.5 billion just in the third quarter of fiscal 2025 alone.
$1.5 billion in a single quarter, just for Gen AI projects.
Exactly. That figure really confirms that their investment thesis is resonating strongly with clients. There's clearly massive demand bubbling up.
Okay, let's come back to that aggressive M&A strategy we touched on. Spending $6.6 billion on 46 acquisitions in fiscal 2024, more than double the previous year's M&A spend. That feels like a very bold, very counter-cyclical move during a slowdown.
It absolutely is. It's the classic strong get stronger playbook. When the overall economy is uncertain and maybe venture capital funding dries up a bit, valuations for smaller, innovative companies often become more reasonable.
So they're buying when others might be hesitant?
Precisely. Accenture is using its enormous free cash flow and its strong balance sheet to strategically scoop up innovation, specialized talent, and market access, especially in hot areas like niche AI applications, cloud security, or industry-specific software platforms capabilities that would likely be much more expensive or take much longer to build organically.
What kinds of companies are they buying specifically? Can you give an example or two?
They're targeting specific gaps or opportunities. For instance, they acquired an AI firm called Halfspace to deepen their advanced data science skills. They've also bought several cloud implementation firms like Nextera in Switzerland or Solnet in New Zealand to strengthen their capabilities in specific geographic markets or with key partners like Google Cloud or SAP. It's very targeted gap filling.
Now, let's talk about something else they launched, which feels strategically brilliant, especially given that cannibalization risk we discussed. That's Accenture LearnVantage.
Yes, this deserves some focus because it directly addresses that core tension around AI potentially automating jobs. In March 2024, Accenture made a significant move by acquiring the online learning platform Udacity and then launching their own B2B professional development platform called Accenture LearnVantage.
Okay, so they bought an education tech company. Why is that so strategically important for Accenture?
Think about the bigger picture. AI is going to automate tasks, potentially displace workers, and fundamentally transform how businesses operate. That's the very disruption Accenture is helping its clients implement, right?
Right.
Well, that disruption creates a massive, urgent, and ongoing global need for corporations to retrain and reskill their existing workforces. Employees need new skills to work alongside AI, to manage AI systems, or to move into higher value roles that AI can't do.
So Accenture helps implement the AI that causes the disruption.
And then they turn around and sell the client the solution LearnVantage to deal with the resulting workforce challenges.
That's clever. They profit from both ends of the disruption.
Exactly. It's a really smart structural hedge. They're positioning themselves to benefit directly from the massive global demand for corporate retraining that AI itself is creating. It helps mitigate the long-term risk that AI might erode their traditional service revenues by creating a new, complementary, and potentially huge revenue stream focused on human capital development.
That shows incredible foresight and agility. Okay, so they're making these big bets on AI, M&A, and reskilling. How can we gauge if these strategies are actually working? What's the key forward-looking metric to watch?
The single most critical leading indicator for Accenture is new bookings. Bookings represent the value of contracts signed during a period which will be converted into revenue in future quarters.
And how did bookings look in fiscal 2024 during that period of slow revenue growth?
They look very strong, actually. Total new bookings for the full fiscal year 2024 reached a massive $81.2 billion, and this resulted in a book-to-bill ratio of 1.25.
1.25. Can you just explain simply what that number means and why it's significant?
Sure. A book-to-bill ratio of 1.25 means that for every $1 of revenue Accenture actually recognized and billed to clients during FY 2024, they signed up $1.25 worth of new contracts for future work.
So they're bringing in new business faster than they're delivering current business.
Exactly. A ratio significantly above 1.0 generally signals strong underlying demand and suggests that the company's sales pipeline is growing faster than its current revenue run rate. It's a strong indicator that the 1.2% revenue growth seen in FY 2024 was likely a trough, and a rebound in revenue growth is probably on the horizon.
And does the mix of those bookings also support the strategic shift towards managed services that we talked about?
It does, very clearly. Managed services bookings grew by a very strong 22.8% year over year in fiscal 2024. That significantly outpaced the growth in consulting bookings.
Okay.
So this confirms that the deliberate strategic push towards more stable, recurring revenue, supported by those big M&A investments in operational capabilities, is successfully translating into long-term contracts being signed. They are locking in that predictable future revenue stream.
And one final point on strategy, there was a major internal reorganization announced more recently in June 2025. What was that about?
Yeah, that looks like a move to further streamline how they deliver these complex solutions, especially around AI. The plan is to consolidate all 5 of those service lines we discussed earlier, strategy and consulting, technology, operations, industry X, and song, into one single unified reinvention services unit.
One big unit.
One big unit, led by a newly created role, the Chief Services Officer. The stated goal seems to be breaking down any remaining internal silos between those groups. They want to ensure that strategy, tech implementation, operational delivery, industry knowledge, and creative services are all brought together seamlessly for the client, all under that central theme of reinvention, with AI integration being the common thread driving pretty much every solution. It's about presenting a unified face and capability to the market.
Okay, that brings us to our final section, part 5. We need to ground this discussion in the current reality. What are the immediate headwinds Accenture is facing? We also need to touch on their governance. And then, crucially, talk about valuation. What's the market actually pricing in right now?
Right. Well, the biggest near-term challenge, the dominant headwind, is still that macroeconomic caution. The global economic picture remains pretty complex. You've got persistent, although maybe easing, inflation in places, still relatively high interest rates compared to a few years ago, ongoing geopolitical tensions.
And this uncertainty directly impacts their clients' spending decisions.
Directly. It doesn't necessarily kill the underlying need for digital transformation or AI, but it definitely makes clients more cautious. It leads to longer sales cycles as deals get more scrutiny internally. It means clients demand clearer proof of near-term ROI before committing. And as we saw in the FY24 numbers, it can lead to outright deferrals of large, non-essential projects until the outlook becomes clearer.
And even for a giant like Accenture, they're not immune to cost pressures, are they? Especially around talent.
Absolutely not. Their biggest cost by far is people's salaries, benefits, training for those 774,000 employees. And wage inflation has been a persistent issue, particularly for the highly specialized skills they desperately need to execute their AI and cloud strategies.
That competition for AI engineers must be fierce.
Fierce is probably an understatement. There's a relatively small global pool of experienced cloud architects, data scientists, and Gen AI specialists. Competing for that talent drives up labor costs significantly, and Accenture then has to either absorb those higher costs, potentially squeezing margins, or try to pass them on to clients, which is tough in the current cautious pricing environment.
And being so global, currency fluctuations must also be a constant headache.
Always a factor for these multinational behemoths. When the US dollar strengthens significantly against other currencies like the euro or the yen, the revenue Accenture earns in those overseas markets translates back into fewer dollars when they report their consolidated results.
Can you give an example of the impact?
Sure. In fiscal 2023, for instance, Accenture's revenue growth in local currency terms was actually around 8%. But because the US dollar was very strong that year, the currency translation effect knocked a full 4 percentage points off that growth. So their reported USD revenue growth was only 4%.
Wow, a 4-point hit just from currency?
Yeah. It's something management can't really control directly, but they constantly have to manage the business to try and offset that kind of external headwind through operational efficiency and pricing.
Okay, let's shift to governance. In a business built so heavily on trust and long-term relationships, the quality and stability of leadership seem really important.
Paramount. And this appears to be a real structural strength for Accenture. The CEO, Julie Sweet, is widely respected and often cited as one of the most influential business leaders globally. More broadly, the executive leadership team shows remarkable stability and depth. The average tenure for the top executives is something like 24 years within Accenture.
24 years. That's incredible loyalty and experience.
It really is. That level of deep institutional knowledge and long-term strategic alignment is critical, especially when you're navigating massive technological shifts like the current move towards AI. It provides continuity.
And that experience and culture presumably feed into what you called the talent moat earlier, helping them attract and keep good people.
Exactly. A strong, positive corporate culture is a genuine competitive advantage in the professional services industry, which traditionally suffers from quite high employee turnover or attrition. Accenture consistently ranks highly on best places to work lists globally. They report something like 82% employee satisfaction worldwide.
And why is that a moat?
Because being seen as an employer of choice helps them attract and, crucially, retain the highly skilled, specialized talent they need, especially in AI and cloud. Reducing costly employee churn and holding on to key experts is vital for delivering complex projects and maintaining client relationships.
Okay, good governance internally. What about their capital allocation? How do they decide what to do with all that cash they generate?
They're known for having a very clear and disciplined capital allocation framework. It's pretty straightforward. Priority 1 is to reinvest cash back into the business for high-return organic growth. That means R&D, developing new services, training their people. Priority 2 is strategic acquisitions, M&A, that fill capability gaps or accelerate growth.
And then what happens with the cash that's left over?
Then, priority 3 is to return the majority of the remaining free cash flow directly to shareholders.
And how much did they return recently?
In fiscal 2024, they returned a substantial $7.8 billion to shareholders. That actually represented about 91% of the total free cash flow they generated that year.
91%. How was that split?
It was split between $4.5 billion used for share buybacks, which reduces the share count and boosts earnings per share, and $3.2 billion paid out as dividends. They have a strong track record here, with 14 consecutive years of increasing their dividend payout.
And why is returning so much cash seen as good governance?
Because it acts as a powerful discipline mechanism on management. Committing to return a large chunk of cash forces them to be highly selective about internal investments or acquisitions. Any project they do fund internally has to promise a return superior to what shareholders could get just from the company buying back its own stock. It prevents empire building or investing in low-return ventures just for the sake of growth.
Right, keeps them focused. Okay, finally, let's bring this all together for the listener and talk about valuation. With the growth slowdown, the AI uncertainty, the investments, how is the stock market pricing Accenture right now?
Well, the stock has definitely undergone a significant derating over the past couple of years. That's largely been driven by those concerns about slowing growth and the uncertainty around how quickly AI will translate into sustainable revenue acceleration. Currently, the stock's valuation, looking at the trailing 12-month price-to-earnings ratio, or TTM/PE, is sitting around 19.0x.
19 times earnings. How does that compare historically for a company like Accenture, which is usually seen as a high-quality premium business? It's actually a pretty substantial discount. That current 19.0x PE is well below its 10-year historical average PE, which is closer to 26.3x. And it's roughly half the peak valuation multiple. It reached around 36.5x PE back in late 2021 during the height of that post-pandemic digital spending boom.
So a big pullback in the multiple the market is willing to pay. If the stock is trading at 19 times earnings, what kind of future growth is the market basically baking into that price right now?
Essentially, a PE of 19x suggests the market is currently pricing in expectations for continued, relatively low, single-digit revenue growth for the foreseeable future. There seems to be quite a bit of skepticism about whether the surge in AI-related work will be large enough, soon enough to fully offset the macroeconomic headwinds and that potential long-term risk of automation cannibalizing older service lines.
So the market is cautious, maybe even a bit pessimistic about the near-term growth outlook. Exactly. And this creates the interesting investment thesis, right? If you believe that Accenture's strategic pivot, the massive M&A spending, the LearnVantage hedge against automation, the strong forward-looking bookings number like that 1.25 book-to-bill ratio, if you believe those moves will successfully re-accelerate growth back towards historical norms over the next few years, then the current valuation could represent a potential opportunity.
Because a return to faster growth would likely lead the market to award the stock a higher PE multiple again.
Precisely. A successful execution of this high-stakes transition could lead to a significant re-rating of the stock's multiple, on top of the earnings growth itself, potentially generating substantial upside for investors. The bet is really on management's ability to navigate this complex AI-driven reinvention successfully.
Okay, that brings us towards the end of this really deep dive into Accenture. It's a complex beast. If we had to boil down this mountain of data, what are the absolute key takeaways for listeners?
I think first, Accenture is still the clear market leader in its space, protected by a really strong economic moat built on that global brand and those high client switching costs. Second, they are very consciously, very deliberately executing a major strategic pivot, shifting the revenue mix towards more stable managed services and investing incredibly heavily, like that $6.6 billion in FY24, into GenAI capabilities and M&A to secure future growth, even amidst the current economic uncertainty.
Right. And third, while that immediate top-line growth really slowed down, hitting just 1.2% in fiscal 2024, the forward-looking indicators look much healthier. That 1.25 book-to-bill ratio and the early surge in GenAI-specific bookings, like $1.5 billion in a quarter, strongly suggest the underlying demand for their services remains robust, hinting at a potential rebound ahead.
Yeah, what really stands out is that tension, that dynamic between the immediate sort of macro-driven pain and caution versus the undeniable long-term necessity for the kind of transformation they enable.
Which leads perfectly into our final thought. What's the one provocative idea or concept listeners should really mull over after hearing all this?
I think it's this idea of a growing transformation debt. Think about it. Right now, macroeconomic caution is forcing many companies to delay or defer those big, ambitious transformation projects they know they probably should be doing.
They're kicking the can down the road.
Exactly. But at the same time, the actual pace of technological change, especially the need to adopt AI just to stay competitive, isn't slowing down. It's arguably accelerating exponentially. So this creates a widening gap, a transformation debt, between where a company's capabilities currently are because they've deferred spending and where they need to be to compete effectively in an AI-driven future.
So this debt is building up quietly in the background.
It's building. And the provocative thought is this. Once a macroeconomic uncertainty lifts, maybe when interest rates stabilize or global growth prospects improve, this large pent-up demand, this urgent need for companies to rapidly modernize and pay down that transformation debt, could be unleashed. It might compel businesses to initiate a massive, synchronized wave of catch-up spending.
A potential boom cycle triggered by deferred necessity.
Yeah. Exactly. A new, potentially very vigorous growth cycle for firms like Accenture, who have strategically used the downturn to build and acquire the exact capabilities needed to help clients close that gap quickly. The question is when and how strong that catch-up wave will be.